Hello and welcome to Pro Trader Strategies Market Commentary for Monday, October the 24th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies so that you can implement them into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. We've got a lot of economic data coming out for a Monday, for that matter, but it's in the form of flash PMI. Now, it is relatively important and widely looked at, but not quite as important as our ISM, which is the Institute for Supply Management PMI's Purchasing Manager Index. But we did get these, and these are a little bit before the overall the overall PMI numbers from the Institute for Supply Management come out. Anyway, we got flash PMI out of France. For the manufacturing sector was 51.3, slightly better than expected. The flash services PMI for the French came in at 52.1, expected to be 54.1. Then on the German side, we got flash PMI on the manufacturing side as 55.1, and on the services side came in at 54.1, both better than expected. Then the overall European flash PMI for the manufacturing side came in at 53.3, was expected 52.7, and then the services PMI came in at 53.5, expected to be 52.4. And then here in the United States, we also got our flash PMI for the manufacturing side, came in at 53.2, was expected 51.6. Now, those PMI numbers are purchasing managers indexes, so it's a survey of purchasing managers for those different sectors. And what that does is it gives us a bit of an idea as to their thought processes going forward. So it's a nice forward-looking metric because if the purchasing managers see the economy's picking up, they're going to obviously start picking up on their manufacturing side and their purchasing of the raw assets that go into those different manufacturing and services sectors. Then the overall markets really started pushing higher on those PMI numbers coming from across the pond, and did a little bit of push higher again for us. One of the things that threw a bit of a wet blanket for a short period of time was a couple of the Fed governors were speaking this morning. We had Bullard speaking and said no urgency to raise rates. December rate raise was like the most likely for the hike. So I've been talking about pushing that down, kicking that can down the road. Not going to happen this in November, but could happen at the beginning of 2017. I don't think they're going to raise rates going into a holiday season. I think that they'll hold off on that, because the last thing we want to do right when we start seeing this economic motivation going on, this economy starting to pick up a little bit of steam, is to raise rates and try and crimp that going into a holiday season. So I think that they're going to hold off at least until the beginning of 2017. The overall markets, as you can see with the crude oil, has come off quite a bit, are about 60 cents on the day, but still above that $50 a barrel psychological level. For the most part, it's tested it, but it's come off of that. Then we got gold down over $4 on the day, came up and tested that 200-day moving average and repelled it rather quickly, especially when the economic data was coming out that started looking pretty decent. The overall gold market started to slide, and as well as the bonds, they're down 25, 26 points on the day. And the thing to keep in mind is it is below that 50 Fibonacci level. So the bears are going to be trying to push that below there and settle below there. And that will be a pretty big indication as to whether or not they're going to be able to keep it there. I think that we're going to see bonds continue to trade sideways along this line and get comfortable right here at the point of control. The 200-day moving average just happens to coincide with that, so that is going to be a major hurdle for the bulls to get over those two levels. That's just a very strong resistance area. On to the Dow Jones Industrial Average, up 94 points on the day, and trying to get above this 200-day moving average, which is going to act as resistance. Overall market still just trending completely sideways in a range between 18,450 and, for the most part, 1788 or 17,988, so we call it 1800, which is going to act as a psychological level of support for the overall bulls. Anyway, on to the NASDAQ, pushing higher, trying very close to testing this 4901 area, 4901 and a half, which is the historical high. We're just right now about 7 points away from that. Don't know, we might see that today with the overall economic numbers that we got out today. It could want to go up there and test that. The only thing, the caveat to that is these Fed governors speaking, talking about a rate hike, and we'll have to see if the overall equities start throwing a tantrum because they don't want interest rates to rise. They want the easy money going on. We got the E-mini S&Ps up almost 10 points on the day, but again, right at that 200-day moving average. Earlier this morning, we did bust above that. The overall liquidation break, if you will, or the longs taking profit came right around, just happened to coincide with Bullard talking about the interest rate hikes. This is the 15-minute chart of the E-mini S&Ps. The overall markets really started rallying quite decently off of those flash PMI numbers across the pond, then consolidated quite a bit. Our flash PMI came out, we went up, made new highs. This is right when Bullard started talking about the increasing interest rates. So the overall market started taking profits there, and we've been pretty much consolidating ever since. The only trade that I've done today is Lululemon, and I decided to throw a strangle on this. They don't have earnings in this expiration cycle, so I decided to try and throw something on there, collect some credit on that, and went into the November and did the 52.5, 62.5 strangle and collected 80 cents for that. So I should be able to be out of that strategy before the next earnings for Lulu, and hopefully get a bit of a pullback in the volatility of that particular market. That way I can collect my premiums rather quickly. All right, that's all I got for you guys today. I hope you all had a great weekend. You can check me out at Wolfman's blog on Twitter. I'm going to be throwing out some trades that I do on the earnings the rest of the week. So follow me on Twitter at Wolfman's blog. Hope to see you all there. And if you can't take that, take it easy.